Have you ever wanted to step into the world of investing, but you're afraid to lose money? Have you ever wondered if there is a safe way to invest? Have you heard about diversifying your portfolio, but do not have enough capital to do so? If you answered yes to any of these questions, then this video is for you. Hello YouTubers, my name is Ankit and welcome to Simply Investing. Today, I'll be talking about exchange traded funds, also known as ETFs. This video will serve as the foundation for the next couple of videos that I plan on doing down the road. So let's get started. An exchange-traded fund, also known as an ETF, is a type of fund that holds multiple underlying assets rather than only one stock. These assets can include stocks, bonds, gold, oil, and foreign currencies. Similar to a stock, the ownership of these assets is divided into shares, except when you buy one share, you're actually buying a very small ownership in each of the companies that are a part of the ETF. ETFs share many similarities to a stock. First, ETFs also have a ticker symbol. Second, as a shareholder, you're entitled to a portion of the profits, which may include dividends as well. And third, ETFs can be bought, sold, or transferred throughout the day, since ETFs are also traded on public stock exchanges. Please note that this feature also differs from a mutual fund, which can only be traded at the end of the day. One key difference between a stock and an ETF is that a stock has a set amount of shares that are being traded back and forth between the investors, whereas the outstanding shares of an ETF can change daily as there is a continuous creation of new shares and redemptions of existing shares. Now, let's take a look at the different types of ETFs. As I mentioned each type of ETF, I will also be providing an example. So to start with, let's look at the index ETFs. Index ETFs are designed to track a particular index like the S&P 500 or NASDAQ. So first here we have iShares Core S&P 500 Index ETF, which is a Canadian hedged ETF, and it trades under the ticker symbol XSP. The dividend yield for this particular ETF is 1.58%, and the dividends are paid out monthly. Next, we have the Bank of Montreal NASDAQ 100 Equity to Canadian Index Fund, which is traded under the ticker symbol ZQQ and pays a dividend of 0.30%. The second type of ETF we'll be taking a look at is the commodity ETF, which is designed to track the price of a commodity such as the gold, oil, or corn. An example of this would be iShares Gold Strategy ETF, which uses the ticker symbol IAUF. The third type of ETF we'll be talking about is the inverse ETF, which is designed to profit from a decline in the underlying market or index. So essentially, as the market is performing poorly, it's going to profit you if you happen to be holding this ETF. This used to be very popular between 2005 to 2009, where we saw a huge market crash, but lately it's not been so popular. An example of this would be the ProShares Ultra Short S&P 500 ETF, which is traded under the ticker symbol SDS. This ETF pays out a dividend of 5.58%. The fourth type of ETF we'll be taking a look at is the actively managed ETF, which is designed to outperform an index. A very popular example of this ETF is the ARK Innovation ETF, which belongs to ARK by Cathie Wood. This ETF has done amazingly well, as you can see in this chart. Now, if we were to take a look at their top 10 holdings, we see that they have some of the very big companies, including Tesla, Square, Roku, and some emerging companies such as CRISPR Therapeutics. The fifth type of ETF we'll be taking a look at is the industry ETF. This ETF is designed to provide you exposure with a particular industry. For example, we can take a look at the tech industry, and here's an ETF called TD Global Tech Leaders Index ETF, which is traded under the ticker symbol TEC.TO, and it pays a dividend of 0.68%. Now, if you're to look at the holdings for this particular ETF, we can see that Their top 10 holdings include Apple, Microsoft, Amazon, Facebook, Alphabet, Tesla, Visa, MasterCard, and Nvidia. So these are some very big companies, and as a Canadian, if you can own this using Canadian dollars, that sounds pretty amazing to me. The next ETF we'll be taking a look at is the Foreign Market ETF. This is designed to track non-US markets. An example of this would be the Horizons China High Yield Index ETF, which is traded under the ticker HCN and provides an annual dividend yield of 5.96%. The seventh type of ETF we'll be taking a look at are bond ETFs. These ETFs are designed to provide exposure to different bonds available at municipal, corporate, or international level. An example of this ETF would be the iShares Core Canadian Universe Bond Index ETF, traded using the ticker XBB, and it provides an annual dividend yield of 2.66%. Now, with bond ETFs, you're not expecting immense growth, however, you're expecting consistent dividends. The eighth type of ETF we'll be taking a look at are the style ETFs. Now, in terms of the style ETFs, I've only dealt with the small versus large cap ETFs, and a prime example of this would be one that's provided by Vanguard, and that is the Vanguard Growth Index Fund ETF, traded with the ticker VUG, and providing an annual dividend yield of 0.89%. Last but not the least, the ninth type of ETF includes the exchange-traded notes. Now, exchange-traded notes are very different from other ETFs that I've mentioned. ETNs do not provide investors ownership of the securities, but they are merely paid the return that the index produces. So essentially, an ETN is more like a bond. It's an unsecured debt note issued by an institution, which promises to pay at maturity the full value of the index minus the management fee. An example of an exchange-traded note would be the Barclays iPath S&P 500 VIX Short-Term Futures ETN, traded under the ticker VXX. To wrap up, here's why one should invest in ETFs. ETFs require lower capital to invest in companies. So rather than buying Tesla for more than $600, one can own Tesla in their portfolio through ARK ETF, which is priced much lower than the Tesla stock. Additionally, ETFs are easy to buy and sell via your brokerage. They also offer you an opportunity to diversify your portfolio while also paying low commission fees on the purchase. Some ETFs offer monthly or quarterly dividends, which make them great for passive income. And lastly, it gives you the independence to manage your risk by investing in different types of ETFs, as mentioned earlier in the video. I really hope you enjoyed this video, and if you did, make sure to drop a like and feel free to let me know in the comment section which ETFs are on your radar moving into 2021. If you're interested in more content like this, where I speak about investing concepts, then make sure to subscribe to the channel and hit the bell button to be notified whenever I release any new and upcoming content about investing. So on that note, thanks a lot for watching today's video, and I'll see you in the next one.